Morning, welcome to the F Word, where we discuss everything about finance. And Francois, I'm joined by Francois, my colleague. Welcome, Francois. It's been a shorter week. Wednesday was of a public holiday, so it's nice to have a little break to catch up on some admin and to do some things with the family. But it's great to have you with me. But today, Francois, I just want to discuss about retirement planning, because at Bovest we realized a lot of people don't know what retirement planning is, either before you actually retire and then at retirement as well. It's very difficult phase. It's an uncertain phase. And we realize that a lot of people have questions regarding that. That's why we had a function in Pretoria. Next week, we're going to have a function in the Garden Route, Bovest's very first function in the Garden Route at Wilderness, at the View. So if you are in the area and you would like to join, please come through to join us there in Wilderness. But I just want to share quickly one or two slides that we are going to discuss, and they just summarize basically what retirement planning is all about. Please let me know. No, that's not the one. If you can see my screen. All right. So, Francois, when we look at retirement planning, there's different phases. So there's a phase before retirement. That's what I'm going to talk to you about quickly today. And then there's a phase at retirement where you can choose between living and life annuity and different products. I'm not going to talk about that today. But when you look at life before retirement, there's different factors that will actually determine where you're going to end up at retirement. So the first one is obviously when you start investing for retirement. So obviously that's within our control, but for a lot of people it might be too late to go back now. But that is a factor that really determines quite a lot where we're going to end up, is when do we start. Then the second factor is how much we put away, what percentage of our salary we put away. Thirdly is when do we retire. I mean, so I know a lot of companies force you to retire at age 60 or 65, but we know now people live longer. So if you can work and you're healthy, to work as long as possible, that will have a great impact. Then there's the replacement ratio, meaning how much do you actually need after retirement. And then lastly, there's the growth of the markets, what your money has done for you while you were busy saving. Now, very important, very interesting, out of all these 5 factors, 4 of them are completely within your control. Only the market growth, is not in your control. 4 of them is within your control. And I just quickly want to show you the impact that if you do change. So if this was your parameters, you started at 25, save 12 and a half, you will have money for 17 years after retirement. Okay, so from age 60 to 77, you will have enough money. Then you'll basically run out of money. But let's change then a couple of things. Let's say you started at age 20, so you started 5 years earlier. That will add another 8 years of money that you will have left. So you will have money now till the age of 85. But let's say you didn't start earlier, but you saved more. Instead of the 12.5%, you saved 18%. That will add 14 years to your retirement money. So you'll have money till the age of 91. Now you say, maybe I couldn't save as much, but I'm going to work longer. So I'm going to work till 65. And that's very important, because now you delay taking some of the money and you have 5 years extra to save.
Yeah.
So that gives you 8 years extra, meaning now you'll have money for 25 years after retirement. So that's up until the age of 90. But now you say, I don't want to work till 65, I want to work till 60, but I'm going to withdraw less. Only 50% of what I earn now, that's the replacement ratio is what they call it. I want to earn less. I'm going to be able to get around with less. So now you'll have 16 years as extra, meaning 33 years over the age of 60. So that's 93. You'll have enough money. And then lastly, let's say if we really can get you a good growth in the investments, that's where advisor will assist you. Your money basically will be able to never run out, depending on what growth you get. So that's just an interesting take, Francois, that a lot of these factors is within our control. And that's why we say retirement planning shouldn't start at the age of 60 or 65. We want to start earlier working with the clients. And that is what we do with our corporate clients. That's what we're going to do at a talk today at church, and I'm going with you later on. So we want to just let people know what they should look out for before retirement and not wait till the day you retire. Now I want to start with retirement planning. So that's just a couple of the factors. Thank you, Francois. Let me know your thoughts, and then let me know what you have for us.
So just a question, I mean, where do you get the 75% income replacement ratio, and what does that actually mean?
Yeah, very good question. So normally the industry will work on 75% replacement ratio, meaning if I earn 10,000 Rand per month today, after my retirement, 7,500 Rand should be enough. Why? Because most of the time the kids are hopefully out of the house and they're not dependent on you anymore. You don't need to drive every day to work. And also very importantly, you're not contributing to a retirement annuity or a pension fund anymore. Whereas of before retirement, you obviously contributed quite a substantial percentage. We know medical costs and all of that is getting more, but to be able, most of the times we see a 75% replacement ratio should be sufficient. And also your property is your property will be paid off and all of that. You don't have a lot of debt. So that's just one of the parameters we work around. But every client's different. Some people want exactly 100% of what they earn now afterwards, and that's where it gets a little bit more personal.
Yeah. So just on my side, a quick calculation that I did a few weeks ago for a client. The client is 20 years old, and he would like to invest and get to 10 million Rand as soon as possible, but he only has close to 1,500 Rand to invest each month, right? So long story short, if we get 10% growth on that, that'll take him about 40 years to get to the 10 million Rand, but that is with a stable 1,500 Rand contribution. But the funny thing is, what I did a quick calculation. If somebody wanted to have that same goal but started 20 years later, they would have to invest more than 13,300 Rand per month. So that just goes to show the power of compounding and compound interest, basically. So what you said as well, between 60 and 65, that's where you see a lot of growth in your fund as well, because most of the heavy lifting has been done. Now the compound growth can just do the rest of that for the next 5 years.
100%. And just lastly on that is to not make mistakes while you're on this journey, because a lot of people now, they work with a company, then they leave the company, they actually have access to the pension provident fund. And we see it so often. Like you say, then you're eroding that compounding interest and you have to start all over again. So definitely do not make mistakes while you're on this journey. Thank you, Francois.
Geo, a quick question on that, and I think that'll roll nicely into the point that I will be making today. Don't you feel when you go and sit with clients when they're 30, 35 years old, you do your projection with them, and they say, well, how am I supposed to put away 5,000 Rand or invest 5,000 Rand, 6,000 Rand per month? That's an astronomical amount of money each month, all of a sudden to invest. Have you seen that as well with some of your clients that you've seen?
Yeah, it's a good question. And once again, there's in theory and then there's reality. So in theory, you sit with him, do all these calculations. You say, right, client, you need to put away 5,000 Rand. But then we look at his reality and say he either cannot put as much away, or he still wants to buy a property for his house, for his wife and kids, or he still wants to pay off his debt. You know, there's definitely personalized situations where you say, okay, in theory, you should save as much. But practically, let's just start with 2,000. Let's at least start. That's what I tell my clients. Let's at least start. We can always build up. And we've seen in the industry over the age of 55, that's when most people save more aggressively because you do have more money. You're at the top of your income level and all of that. So, but what I say to them is we're going to start. Even if we start with a small amount, that's 100% fine. But let's get into that habit. And then we work towards our goal still, but we start maybe a little bit lower than we initially would like to.
Yeah, and I think that's a brilliant point that you just made, and I don't think you even thought about it. It's the habit. It's forming a habit. Just like we all need to pay our rent, our bond, our cars, medical aid, all that stuff. Investing becomes an habit, and it needs to be a habit. That's what it's about. So all of a sudden, you're trying to sit with a client, and they don't have this habit yet at 30 or 35, 40, whatever it may be. And trying to get that client into the habit now of making tweaks in their budget that they used to spend on all your luxuries or whatever it may be, to say, well, what's our priority now? Is our priorities now to start saving for retirement? Because it doesn't help that we just kick the can down the road. And that just blends into, my piece for today. And that is, at the end of the day, Morgan Housel said it very well. You cannot become wealthy by spending on things that don't matter. All those luxuries, all those things, you need to start the habit of saving first. And as you've said many, many times, pay your future self first. So you don't become wealthy by spending. That's something that people just don't understand. You don't become wealthy by spending. All right? The other thing that I wanted to say as well, we need to start making financial decisions that make us sleep better at night. Now, this is a very big thing for people where they struggle with their financial decisions and it's keeping them up at night, but they don't get themselves where they reach out and they want to get help or financial advice in making the right decisions moving forward. So everybody's different. You get people that are very, very easy and happy having debt. And then you get people that are very uneasy having debt. I'm one of those people because I didn't grow up with that mindset of debt. But you do get a lot of people, they're happy with having a credit card of 50,000 Rand or 60,000 Rand. And as well, having then an investment, a flexible investment of 100,000 Rand. It doesn't always make sense to me, but it makes sense to the client and they can sleep at night having that over their heads. So make financial decisions that make you sleep better at night. And if you're not sleeping well because of these decisions, get help and start making progress towards the right financial decisions. The other thing that I wanted to say as well, define the game that you're playing. We've spoken about this before. Everybody's got a different game that they're playing. They've got a different pathway that they're following. I know you haven't told me yet, but you're now buying a home, Hugh. So you're playing a different game than somebody who doesn't want to have a property and they're happy with renting for the rest of their lives because it makes sense for them because their rent is less than a bond. All right, so it makes financial sense to them. They're happy. They don't have the overheads if a geyser bursts or the painting and all that stuff. It makes sense to them. So when you're at a social event and somebody starts giving you a few nuggets of gold, just remember they are running a different race. They're playing a different game than you are. And by trying to compare yourself to them is basically trying to play tennis with a hockey stick. It just doesn't work because you're not playing the same game.
No. Francois, thank you very much for that. And just quickly on the property, we can have another podcast on that. But for me, I was struggling a lot between renting and buying. And for me, I'm actually think it's more financial. It makes more sense to just rent in theory. So that's the theory part. But then there's the reality side. With your wife and your kids, they want somewhere that they can feel home. It's the emotional side, the emotional connection. So 100%. And one thing, talking about habit, is what a property actually does is it forces you to pay off your bond. So to put money into an asset. Because like I say, if it was retirement money or a flexible investment, maybe I delay it this month, maybe I delay it. You just keep kicking it down the road. But a property forces you every month to pay your bond. So to invest in assets. So that's one thing a property actually does do. And that's some sound advice from Dr. Rian Botha, my father at Bovest. He said, because that's what a property actually does. It forces you. So in 10 years' time, you'll at least have an asset of worth whatever the property is worth. So just once again, that habit. But thank you, Francois. All the best for the weekend. Enjoy your weekend and see you then.
Thank you, Hugh.